Hello, accounting students. We are currently working on Chapter 12. Chapter 12 has 4 lessons, and Chapter 12 deals with preparing payroll records. As we look at the first lesson in Chapter 12, so lesson number 1, you can see that the first thing we're going to be doing is calculating employee earnings. So our 2 objectives for this lesson are to explain how employees are paid, and then also to calculate hourly employee earnings. This chapter actually does have a lot of vocabulary in it, so we're going to talk a little bit about the vocabulary. But one thing we want to keep in mind as we start to think about employee earnings is how much money a business spends on employee earnings. Okay, so again, a bunch of vocabulary. The amount of money that an employee is paid for every hour worked is called their wage. If you receive a fixed amount of money on an annual basis, that's salary. And so oftentimes when you get paid on a salary, your set amount of wage is divided by 26 if you're paid every 2 weeks, by 24 if you're paid bi-monthly, or by 12 if you're paid monthly. One of the ways that we can pay employees if we would like to base it on activity from your employees is commission. So most frequently commission is tied to sales, and employees would receive commission-based pay based on how much they generate in sales. So the total amount that's paid by a business for the employee's work, either earned by a wage, a salary, or commission, is called their total earnings. Total earnings, we sometimes refer to this as gross. Okay, so gross pay, gross wages, gross earnings. We talk about that total amount as an amount in gross. And to keep in mind that for most businesses, paying payroll is actually the largest expense for the business. All right, so when we pay employees, the pay period is the number of days or works of week that are covered by an employee's paycheck. Some people are paid weekly. Some people are paid bi-weekly or every 2 weeks. Some people are paid twice a month. And typically if you're paid twice a month, you're paid on the 1st and the 15th, or you're paid on the 15th and the end of the month, the 30th, 31st, 29 if it's a leap year in February. But typically employees are paid on the 1st and the 15th if they're semi-monthly. And then some folks then are also just paid once a month, which would be considered a monthly payroll. Now, the total amount that's earned by all employees in a pay period is called the payroll. And an accounting staff position that puts all of the information together to pay payroll is called the payroll clerk. So they take all the data, they prepare, journal, and post all of the transactions tied to payroll. And we call that person a payroll clerk. So calculating the hours that your employees have worked, most businesses that pay people on an hourly basis have some kind of time clock. And this is a device that's used to record the date and the time that employees arrive to work and depart from work. And most companies nowadays are moving to much more electronic-based payroll systems where employees say when they get to work on the register they log in, and that records the time of their arrival. Sometimes people are really have good financial and accounting systems, and they might even swipe a card that is what allows them to go ahead and record their arrival time or their departure time. Now, what we're looking at here is a paper copy of what we could see as a time card. And so the information that's going to be recorded is going to be the day of the pay period. So it's the pay period ending December 15th, but you can see we have the first day of the pay period, which is the 1st, and then the 2nd all the way down to the 15th. And you can see the person is reporting in at 7:59, out at 12:02 for lunch, in at 12:59, and then out at 4:53 for the day. And so this person is leaving for lunch every day and taking about an hour for lunch, and you can see that they're recording about 8 hours per day. Now, this particular employer, so as we're looking at 3 green, you want to keep in mind that the rules for paying overtime for on a federal level indicate that if you're going to pay employees, you have to pay 1.5 times the normal hourly rate for hours worked in excess of 40 hours. 3 green goes above and beyond that, and they actually pay overtime for any hours over 8 hours worked per day. So that's why you're seeing that there's 2.5 hours of overtime on this particular time card. So just in looking at, time clock system, sorry, I went too fast. Obviously these time clock systems generate reports for us in our business, and we can use those reports to see, are there any particular days of the month where our employees are having to work more? Are there any particular weeks of a month where our employees are having to work more? Is there any trending that we can look at? And then we just really get some good information on how many hours our employees are working, and it helps us to be able to establish some staffing information. So using reports from the time clock system can be very helpful for the business as a whole. So when we're going to calculate an employee's total earnings if they have an hourly wage, you can see that this employee had 88 hours at their regular rate of $15 per hour. Then we go ahead and do a separate calculation for their overtime. So their overtime is paid at 1.5 times their regular salary, or $22.50 an hour, and they worked 6.5 overtime hours, resulting times their overtime rate in an additional $146.25. So the total earnings is going to be their regular earning plus their overtime earnings. All right, so this was a pretty short lesson. What is payroll? And just to remember, this is the total amount earned by all employees for a pay period. That's what payroll is. 3 methods used by modern time clock systems to record employee arrival and departure: swiping name badge, keying in personal identification numbers, pressing a finger on a biometric pad to record arrival or departure. One thing that you want to just be very aware of and very sensitive to is that employees need to log themselves in and out of work, and that you as an employee would never want to sign someone else in or sign someone else out or punch anybody else's time card. Describe overtime rules of the Fair Labor Standards Act. And this is the act that requires most businesses involved in interstate commerce, pay employees at least 1.5 times their normal hourly rate for hours worked in excess of 40. And then again, 3 green does 1.5 times the normal hourly rate for more than 8 hours per day or 40 hours per week. So they're using 2, and they're being more generous than the federal law requires them to be. So from here, you should go ahead and complete the forms online, the work together, and on your own activities for lesson 1 for chapter 12. All right, good luck.